Before we begin, please note that I am not a licensed financial advisor, mortgage broker, or attorney. This presentation is for informational and educational purposes only and should not be considered financial, legal, or tax advice. The home buying process is complex and varies by state and individual circumstances. Always consult with qualified professionals, including a financial advisor, a real estate attorney, and your loan officer, before making any financial decisions. Picture this. You did it. You saved for years, you sacrificed, you built your credit score from the ground up. You found the perfect house, the one with the big backyard for the dog, the great school district, the kitchen you've been dreaming about. You navigated the bidding war, your offer was accepted, and you are floating on air. The finish line is in sight. You can almost feel the keys in your hand. And then, just a few days before closing, you get an email. It's a document called the closing disclosure. And when you open it, your heart sinks into your stomach. You're looking at a list of fees, a tidal wave of charges you've never heard of. Underwriting fees, processing fees, title insurance, escrow fees, recording fees, courier fees. It's a page-long assault of financial jargon. And at the very bottom, there's a number. A huge number. A number that's $5, $10, maybe even $15,000 more than you were expecting. Suddenly, the dream feels like a trap. Where is this money supposed to come from? Did you do something wrong? Is this even legal? This exact moment of panic, this gut punch of financial shock, is one of the most common and least talked about nightmares in American real estate. It's called sticker shock, and it's caused by closing costs. The average homebuyer in the United States pays between 2 and 5% of their loan amount in closing costs. Let's put that in real numbers. On a $400,000 home, that's anywhere from $8,000 to a staggering $20,000. This is cash you have to bring to the table on closing day, on top of your down payment. It's a massive expense that blindsides millions of people every single year. Why? Because the entire system feels like a black box. It's designed to be confusing. It's a maze of acronyms and obscure line items that make even savvy people feel powerless and overwhelmed. But what if I told you that it doesn't have to be this way? What if I told you that inside that confusing document is a hidden opportunity? An opportunity to save thousands of dollars, to take back control, and to walk into your closing with absolute confidence instead of fear. That is the entire purpose of this video. We are going to kick down the door on the black box of closing costs. We are going to demystify every single line item, expose the junk fees, and give you the exact knowledge and scripts you need to question, challenge, and negotiate these costs. This isn't just about understanding a document. It's about shifting the power dynamic back to you, the homebuyer. By the end of this journey, you won't just know what an endorsement fee is. You'll know if the one you're being charged is fair, and you'll know exactly what to say about it. So how do we do this? We start at the beginning with the two most important documents you will ever see in your home loan process: the loan estimate and the closing disclosure. Think of these as the rulebook and the final scorecard for your loan. The loan estimate is what the lender gives you at the beginning of the process. It's their best guess of what your costs will be. The closing disclosure is what you get at the end, and it's the final itemized bill. The law says these two documents have to be pretty similar, but the devil is in the details, and those details are where lenders and other third parties can pack in fees that you might not need to pay. Our mission is to make you an expert at reading these documents. We're going to break them down into three main buckets of costs, three categories that contain virtually every fee you'll ever see. The first bucket is lender fees. These are the charges your bank or mortgage company keeps for themselves. This is their profit. It includes things like the origination fee, processing fees, underwriting fees, and discount points. This bucket is critical because it's often the most negotiable part of the entire equation. Lenders are in a competitive business and they want your loan. Knowing how to intelligently question these fees can directly put money back into your pocket. The second bucket is third-party fees. This is the biggest and most confusing category for most people. These are fees for services performed by other companies that are required to get your loan to the finish line. We're talking about the appraisal fee to determine the home's value, the credit report fee, the flood certification fee. But most importantly, this bucket contains the title and escrow fees. These are the costs for making sure the property you're buying has a clean history, and for handling the massive exchange of money and documents. This area is filled with potential junk fees and inflated charges, and we're going to shine a very bright light on them. The third and final bucket is what we call prepaids and escrow funding. This one is a little different. This isn't really a fee in the traditional sense. This is you, the homebuyer, prepaying for things you'd have to pay for anyway as a homeowner. We're talking about your homeowner's insurance, your property taxes, and the daily mortgage interest that accrues before your first official payment. The lender requires you to pay some of this upfront to create a safety cushion, which they hold for you in an account called Escrow. While these costs themselves aren't typically negotiable, you can't negotiate your tax rate. The amount the lender requires you to put into escrow can sometimes be questioned, and understanding how it works is absolutely crucial for your cash-to-close calculation. Lender fees, third-party fees, and prepaids. That's it. Every single one of the dozens of confusing line items on your disclosure falls into one of these three buckets. Over the next several parts, we are going to dissect each bucket piece by piece. We will go through every common fee one by one. I'll explain what it's for, what a typical cost is in today's market, whether it's negotiable, and most importantly, what you can do about it. You will learn the difference between a zero-cost loan and a no-fee loan. And trust me, they are not the same thing. You'll understand why shopping for title insurance can save you $1,000 or more, something 90% of buyers never do. You'll learn how to spot duplicate charges and unnecessary junk fees that lenders sometimes slip in, hoping you won't notice. This is your roadmap. This is your guide to turning the most stressful part of buying a home into your greatest source of savings and empowerment. Let's get started. The first document you'll see, the one that pulls back the curtain on this whole mysterious process, is called the loan estimate. You get this within 3 days of applying for a mortgage. Think of it as the price tag for your loan. But unlike a simple price tag at the grocery store, this one is 3 pages long, filled with jargon, and can feel like it's written in another language. Most people get it, their eyes glaze over, they see the big number at the bottom and they panic. But not you, because you're going to understand that this document isn't a bill. It's a battlefield. It's where you start fighting for every single dollar. To make sense of it all, we're going to ignore the confusing government layout and instead sort every single closing cost into one of 3 simple buckets. Imagine 3 buckets sitting in front of you. That's it. Every single fee, tax, and charge will go into one of these. Bucket number 1 is for lender fees. These are the charges your specific bank or mortgage company is charging you to create, approve, and fund your loan. This is their profit. This is the bucket you have the most control over. Bucket number 2 is for third-party services. These are fees for services required to get the loan, but they're performed by other companies, not your lender. Think appraisers, title companies, and credit reporting agencies. You have some control here, but it's a different game. And bucket number 3 is for prepaids and escrows. This is the your money bucket. It's not a fee at all. It's you prepaying things you'd have to pay anyway, like property taxes and homeowners insurance. The lender collects it up front for security. That's it. Lender fees, third-party fees, and your money. By sorting the chaos into these 3 buckets, you can instantly see where you can negotiate, where you can shop around, and where you just have to pay. Today, we are laser-focused on that first bucket, the lender fees. This is where you can save thousands of dollars with a single phone call. These fees are the lender's direct compensation for giving you the loan. They are 100% set by the lender, which means they are 100% negotiable. When you get loan estimates from 3 different lenders, this is the section you compare line by line like a hawk. The biggest and most important fee in this bucket is the origination charge. Sometimes it's a flat fee like $2,000. Sometimes it's a percentage of the loan amount, usually around 1%. This is the lender's main fee for doing the work. It's the cover charge for the club. It pays for their loan officers, their paperwork, their office lights, everything. Now, right next to the origination charge, you might see something called points or discount points. This is one of the most misunderstood concepts in all of real estate, and lenders love that confusion. Here's the simple truth. 1 point costs 1% of your loan amount. So on a $400,000 loan, 1 point costs you $4,000, paid upfront at closing. And what does it do? It buys you a slightly lower interest rate for the life of the loan. You are literally paying a big chunk of cash today in exchange for a slightly smaller monthly payment for the next 30 years. It's prepaid interest. So is it a good deal? Well, you have to do the math. Let's say paying $4,000 for that 1 point saves you $75 a month on your mortgage payment. You would divide the cost, $4,000, by the monthly savings, $75. The answer is about 53. That means it will take you 53 months or almost 4.5 years just to break even on the money you paid up front. If you know with 100% certainty that you will be in that house and not refinance for longer than 4.5 years, then paying for points might save you money in the long run. But for most people, especially first-time buyers who often move or refinance within 5 to 7 years, paying for points is like giving the bank a massive, interest-free loan that you might never get back. Many smart buyers opt for a 0-point loan. You might have a slightly higher rate, but you keep that $4,000 in your pocket for moving expenses, furniture, or your emergency fund. Always ask your lender to show you options with and without points. Don't let them just assume you want to pay them. Okay, moving down the list of lender fees. You'll see a bunch of smaller professional-sounding charges. These are what I call the a la carte fees. The lender breaks out their origination charge into smaller pieces, hoping it looks like less. You'll see an underwriting fee. This is a legitimate charge. Underwriting is the process where a financial detective at the lender's office scours through your bank statements, your pay stubs, and your tax returns to make sure you're not a risk. They're the final gatekeeper. This fee typically runs from $500 to $1,000. Then there's the processing fee. The processor is the person who gathers all your documents, organizes the file, and hands it off to the underwriter. They're the project manager for your loan file. Again, a legitimate service, and the fee is usually a few $100s. You might also see an application fee. Be careful with this one. Some lenders charge this just to take your application, and it's often non-refundable, even if you get denied or choose another lender. A reputable lender usually rolls this cost into the overall origination charge that you only pay if the loan actually closes. If a lender demands a $300 application fee just to talk to you, that can be a red flag. Now we get to the really fun part. The part the lenders hope you're too tired to read. This is where we find the junk fees. These are completely bogus, made-up charges that some, not all lenders will slip in to pad their profits. They give them official-sounding names, but they're pure fluff. Have you ever seen a document preparation fee? You're paying them thousands in origination already. What do you think that's for, if not to prepare documents? That's like a restaurant charging you an eating fee on top of the price of the food. It's part of the service. Or how about a funding fee or an administrative fee? Again, what are you paying the origination charge for? Funding the loan and administering the file is their entire job. These are redundant. You might see a tax service fee or a wire transfer fee. While there are small, real costs associated with these, they are often inflated or should be included as a cost of doing business for the lender. Here's the secret. These fees aren't set in stone. They are not regulated government charges. They are 100% at the discretion of the lender. When you're comparing loan estimates, add up every single one of these lender fees, the origination, the underwriting, the processing, and all the little junk fees into one single number. This is your total lender cost. Don't let one lender fool you by advertising a low origination fee of $500, only to then tack on $1,500 in junk fees. Meanwhile, another lender might have a $2,000 origination fee and nothing else. They cost the exact same. You have to add it all up. This total lender cost is your negotiation ammo. You can go back to lender A and say, look, lender B is offering me the same interest rate, but their total lender fees are $500 cheaper. Can you match that? More often than not, you'll hear a pause, some typing, and then, okay, let me see what I can do. Those junk fees? They'll magically disappear. That is a $500 savings you just made in a 2-minute phone call. This first bucket, the lender fees, is where your power as a consumer is greatest. You can question every single line item. You can, and you absolutely must, get multiple quotes and force lenders to compete for your business. Don't be shy. Don't feel bad. This is business. It's the biggest financial transaction of your life, and you are the CEO of this deal. But what about the fees you can't directly negotiate with your lender? The costs for the army of other professionals involved, the appraisers who value the home, the title agents who ensure you actually own it, the government clerks who record the deed. That's our second bucket, the world of third-party fees. It's a different landscape with its own rules and its own traps, and knowing how to navigate it is just as critical. That's where we're going next. So let's walk into that landscape. This second bucket of closing costs, the third-party fees, is fundamentally different from the lender fees we just talked about. The lender isn't making a profit here. Instead, you're paying for a team of independent specialists whose job is to protect you and the lender from very specific, very expensive disasters. Think of it less as paying fees and more as hiring your own personal home buying protection squad. You're the general manager, and these are your expert draft picks. Your first hire, and one of the most important, is the appraiser. The bank has agreed, in theory, to lend you hundreds of thousands of dollars. But they're not just lending it to you, they're lending it against the house. The house is the collateral. If you stop paying, they take the house. So they have one burning question. Is this house actually worth what you've agreed to pay for it? Because if you're paying $400,000 for a house that's only worth $300,000, and you default, the bank is out $100,000. They will not take that risk. So they hire an independent third-party licensed appraiser. This person has one job: to provide an unbiased, professional opinion of the property's fair market value. They are the ultimate reality check. They don't care about the beautiful letter you wrote to the seller, or that you've already picked out paint colors. They are cold, hard data analysts. They'll visit the property, measure it, note its condition, and then compare it to at least 3 similar homes or comps that have recently sold in the same neighborhood. Based on that data, they produce a detailed report that says, yes, this house is worth $400,000. Or in a scenario that strikes fear into the hearts of buyers everywhere, no, it's only worth $380,000. The cost for this service is the appraisal fee. You typically pay this early in the process, sometimes even before your loan is fully approved, because the lender won't move forward without it. And here's the critical part. You can't choose your own appraiser. To prevent fraud, like you hiring your cousin Vinny to say your shack is a mansion, the lender orders the appraisal through an independent management company. The fee can range from $400 to over $1,000, depending on the property's size, complexity, and location. It's non-negotiable and non-refundable. Even if the deal falls through, you paid for an expert opinion and you got one regardless of the outcome. Now, what if the appraisal comes in low? That's a whole other video, but in short, it becomes a new negotiation. You might have to bring more cash to the table, the seller might have to lower the price, or you might meet in the middle. But without that appraiser on your team, you could have been the person who overpaid by $20,000, losing that equity from day one. They're your first line of financial defense. Okay, your second and arguably most critical hire is the title company. If the appraiser protects you from overpaying, the title company protects you from something far more terrifying: buying a house that the seller doesn't actually have the legal right to sell. Imagine this nightmare. You buy your dream home. You move in, you paint the walls, you plant a garden. A year later, a stranger knocks on your door and says, "This is a lovely house. It's a shame my uncle sold it to you, because when my grandmother died, she left it to me in her will. Here's the paperwork. Get out." This isn't just a movie plot. It can happen. Ownership of property or title can be incredibly messy. There can be old, unpaid contractor liens, boundary disputes with neighbors, undisclosed heirs, forged signatures on old documents, or tax claims from decades ago. Any one of these issues is called a cloud or defect on the title. If you buy a property with a clouded title, you inherit the cloud and the financial and legal disaster that comes with it. Enter the title company, your property historian and legal guardian. Their role is twofold, and you'll see 2 corresponding charges on your closing statement. First is the title search. They act as detectives. They dive deep into the public records: deeds, mortgages, wills, divorce settlements, court judgments, tax records, everything related to your property's history. They are looking for any of those clouds. They want to establish a clear, unbroken chain of ownership leading directly to the current seller. The fee for this detective work is the title search fee. It's the cost of the labor to ensure the coast is clear. But what if the detectives miss something? What if there's a forged document from 1972 that no one could possibly have detected? That's where the second, much larger fee comes in: title insurance. This is not like your homeowner's insurance that you pay every year. Title insurance is a one-time premium you pay at closing that protects you for as long as you or your heirs own the property. It's a financial force field against any past title problems that might surface in the future. And here's where it gets a little confusing, because you're actually buying 2 separate policies. The first is the lender's title insurance policy. This is mandatory. You cannot get a mortgage without it. This policy protects only the lender. It guarantees that if a title claim arises, the bank will get its money back first. The coverage amount decreases as you pay down your loan. You are required to buy this policy to protect the bank's investment in your property. The second policy is the owner's title insurance policy. This protects you. It protects your down payment, your equity, and your legal right to the property. If that long-lost heir shows up, your owner's policy is what pays for the lawyers, and in a worst-case scenario, compensates you for the entire value of your home. In most states, this is technically optional, but going without it is like driving a brand new car off the lot without getting collision insurance. The risk is catastrophic. The one-time cost, which could be $1,000 or $2,000, is microscopic compared to the risk of losing your entire home. So when you see the title fees, remember you're hiring a detective to check the past and buying a lifetime force field to protect your future. Now, your protection squad has other members too. You'll see a small fee for a credit report. The lender needs to pull your detailed credit history and scores from the 3 main bureaus, Equifax, Experian, and TransUnion. They pass that cost directly on to you. It's usually under $50. You might also see a flood certification fee. This is for a third-party company to officially determine if your property is in a federally designated flood zone. This certification dictates whether you'll be required to purchase separate flood insurance, which is another cost entirely. Again, it's a small fee for a crucial piece of data. Depending on the property, you might also need a survey fee. A surveyor will come out and physically map the property, verifying the boundary lines and making sure your neighbor's new shed isn't actually 3 feet onto your land. This isn't always required, but if there's any ambiguity about the property lines, the lender or title company might insist on it. Now for the key question. Can you save money here? Unlike the lender's fees, which are set by the lender, many of these third-party fees are shoppable. The law requires your lender to give you a list of approved providers, but it also says you have the right to choose your own, as long as they meet the lender's requirements. The single biggest place to save is with the title company. You can and should call several title companies or attorneys in your area and compare quotes for their services, and most importantly, for the owner's title insurance premium. The rates can vary significantly, and a few phone calls could easily save you hundreds of dollars. The services you can't shop for are the appraisal and the credit report, as the lender must control who performs those tasks to ensure impartiality. So we've assembled our team. The appraiser has confirmed the value. The title company has cleared the property's history and ensured its future. We've checked the credit, the flood maps, and the property lines. We've paid for all the experts who have done their work up to this point. But there's a third giant bucket of costs waiting for us at the closing table. These aren't fees for services already rendered. These are prepayments. Money you have to pay up front for expenses you haven't even incurred yet, like property taxes and homeowners insurance. This is the world of prepaids and escrow accounts, and frankly, it's the category that causes the most sticker shock and confusion for homebuyers. And that is exactly where we're going next. Alright, let's dive into the deep end. This is where your closing cost statement suddenly feels like it's written in a foreign language. Prepaids and escrow. It sounds boring, but I promise you, this is the single category that will make you pick up the phone and ask your loan officer, is this a typo? So what is it? Think of it this way, everything we've talked about so far, the lender fees, the third-party fees, those were payments for services already rendered. The appraisal was done. The credit report was pulled. The loan was processed. You're paying for the work that got you to the closing table. Prepaids and escrow are different. This is you paying for expenses that haven't even happened yet. You're paying for the future. And your lender is making absolutely sure you do. Why? Let's get inside the lender's head for a second. They are about to give you hundreds of thousands of dollars, secured by one thing: your house. That house is their collateral. It's their safety net. If you stop paying your mortgage, they take the house back to recoup their money. So they have a massive vested interest in protecting that house. What are the 2 biggest threats to that house that aren't you? 1, a catastrophic event like a fire. 2, the government. If your house burns to the ground and you don't have homeowners insurance, the lender's collateral is literally a pile of ash. They've lost everything. And if you stop paying your property taxes, the county or municipality can put a lien on your home and eventually foreclose on it, seizing it to pay your tax debt. In a tax foreclosure, the government's claim on your house is often superior to the lender's. They get paid first. The lender could be left with nothing. So the lender looks at these 2 giant risks, fire and the taxman, and says, absolutely not. I am not going to let my multi-$100,000 investment go up in smoke or get seized by the county because the borrower forgot to pay a bill. Their solution is the escrow account. An escrow account, sometimes called an impound account, is essentially a forced savings account that the lender manages for you. Every month, when you make your mortgage payment, it's not just principal and interest. It's PITI, principal, interest, taxes, and insurance. A portion of your payment gets diverted into this special savings account. Then, when your property tax bill and homeowner's insurance premium are due, the lender pays them for you on your behalf, using the money from that account. It's a non-negotiable system to ensure the two most important bills related to the house get paid on time, every time. So, where does the sticker shock come from? It comes from setting up this account. You can't start a savings account with $0. You have to fund it. And that's what happens at closing. Let's break down the big items you'll see in this section. First, prepaid homeowners insurance. Your lender will require you to pay for your first full year of homeowners insurance upfront. At closing, you have to go out, shop for a policy, find an insurer you like, and pay that entire first year's premium. Why? Because an insurance company won't issue a policy until it's paid for. And the lender won't give you the loan until they see proof that the house is insured on day one. It's a classic chicken and egg scenario, and it's solved by you paying for the whole year at the closing table. So if your policy is, say, $1,200 a year, that's a $1,200 line item right there on your closing statement. But wait, there's more. On top of paying for that entire first year, the lender will also want to start funding your escrow account for the second year's policy. Remember, your monthly PITI payment includes 1/12 of your annual insurance premium. So if your policy is $1,200, you'll be paying an extra $100 a month into your escrow account. The lender wants to make sure there's a buffer in there. Federal law allows them to keep a cushion in your escrow account equal to 2 months' worth of escrow payments. So at closing, they will likely collect 2 months of homeowners insurance payments from you to put into that cushion. In our example, that's another $200. So for insurance alone, you've paid for 12 months up front, plus another 2 months for the escrow cushion. That's 14 months of insurance premiums you're paying on closing day. You can see how this starts to add up. Now let's talk about the even more confusing one, property taxes. Unlike insurance, you don't pay a year of property taxes up front. But the lender still needs to establish that escrow account and make sure there's enough cash in it to pay the first tax bill when it comes due. The tricky part is that every state, county, and city has a different schedule for collecting taxes. They might bill twice a year or 4 times a year. And they usually bill in arrears, meaning you're paying for a period you've already lived through. Let's use a real-world example. Imagine you're closing on your house on September 15th. And let's say your local tax collector sends out bills twice a year. One bill due in November that covers July through December, and one in May that covers January through June. When you close on September 15th, the first tax bill your lender will have to pay is the one due in November. They need to have enough money in your escrow account to pay that bill. So what do? At closing, they will collect enough months of property taxes from you to ensure the account is funded. You've already lived there for half of September. You'll be there for October and November. The lender needs to make sure the money for those months, plus any previous months in that tax period covered by the seller, is in the account. The exact calculation is complex, but the simple version is this. The lender looks at the date of your first mortgage payment and the date the next tax bill is due. They figure out how many monthly deposits you'll make between those two dates, and then they charge you the difference at closing to make sure there's enough money to pay that first bill. And just like with insurance, they will also collect that 2-month cushion. So if your annual property taxes are, say, $3,600 or $300 a month, they'll collect whatever number of months they need to seed the account, plus an extra $600 for that 2-month buffer. This is often the single largest item in this category. It can be thousands of dollars, and it's not a fee. It's your money going into your savings account for your taxes, but you have to pay it all at once. The last piece of this puzzle is prepaid daily interest. This one feels a little unfair until you understand it. When you get a mortgage, your payments are also made in arrears. The payment you make on December 1st is paying for the interest that accrued during the month of November. The payment on January 1st pays for December's interest, and so on. But what happens if you close on, say, October 20th? Your first mortgage payment won't be until December 1st. That December 1st payment will cover the interest for November. But who pays the interest for those last 11 days in October, from the 20th to the 31st? You do. At the closing table, they calculate the interest you owe per day, the per diem interest, and multiply it by the number of days left in the month of closing. This brings the loan current so that the normal monthly payment cycle can begin. So let's recap the sticker shock of the prepaids and escrow section. Closing, you are paying 1 full year of your homeowner's insurance premium, plus an extra couple of months of insurance premiums for your escrow cushion, plus several months of property taxes to seed your escrow account, plus an extra 2 months of property taxes for that same cushion, plus the daily interest on your loan from the day you close until the end of the month. When you add all of that up, it can easily be $4,000, $5,000, $6,000 or more, depending on your property taxes and insurance costs. And when you see that number, your first reaction is to think it's a cost or a fee. But it's critical to remember, most of this money is still yours. It's just being held in a separate account that you don't control for your own good and, more importantly, for the lender's protection. We've now demystified the lender's fees, the third-party reports, and this monster category of prepaids. We've covered the costs of setting up the loan and securing its future. But what about securing its past? What happens if, 5 years after you move in, someone knocks on your door with a dusty old deed from 1950, claiming their great-uncle actually owns your property? How do you protect yourself from a ghost from the property's history coming back to stake a claim on your home? That protection is called title insurance. And it is, without a doubt, one of the most obscure, most important, and most misunderstood costs in this entire process. And it is precisely where we are headed next. Title insurance is your financial bodyguard, standing guard against the past. Think about it. Every other type of insurance you buy, homeowners, car, health, protects you against something that might happen in the future. A fire, a car accident, an illness. Title insurance is completely different. It's the only insurance you buy that protects you from things that have already happened in the past, lurking in the property's history like a hidden landmine. To understand why this is so critical, you first have to understand what a title is. It's not that piece of paper they hand you. The actual paper is a deed. The title is a legal concept. It's the abstract idea of your right to own, use, and sell the property. And that concept can be damaged, or what the industry calls clouded. A clouded title means someone else might have a legitimate legal claim to your property. Imagine buying your dream home, moving in, painting the walls, only to get a certified letter a year later from a lawyer representing the long-lost heir of a previous owner who claims the sale was illegitimate. Or discovering that the person who sold you the house had forged their deceased spouse's signature on the deed. Or finding out a contractor who put a new roof on the house 5 years ago never got paid, and they've placed a legal claim, a lien, against the property for $30,000. A lien that is now your problem. These aren't made-up horror stories. They are the exact kinds of title defects that can and do surface, sometimes decades after a transaction. So, how do you protect yourself? It starts with something called a title search. Before you close, the title company acts like a team of historical detectives. They dive deep into the public records. We're talking deeds, mortgages, wills, divorce decrees, court judgments, tax records, and more, sometimes going back 50 years or more. Their job is to trace the lineage of ownership and uncover any of these potential landmines. They're looking for any breaks in the chain of ownership, any unpaid liens, any unresolved legal issues that could threaten your claim to the property. Once they complete this exhaustive search, they issue a report. If the title is clear, fantastic. But if they find issues, those have to be resolved before you can close. For example, maybe a previous mortgage was paid off but never legally recorded as satisfied. The title company will work to get that fixed. But here's the most important part. What if the detectives miss something? What if there's a hidden issue that even the most thorough search couldn't uncover? A forged signature, a fraudulent document, a missing heir that nobody knew existed. These are the invisible threats. This is where the insurance part of title insurance comes in. It's a policy that protects you from the undiscovered defects. Now, this is where it gets confusing for almost everyone because you're not buying one policy at the closing table. You're typically involved with two: the lender's policy and the owner's policy. And you need to know the difference. First, the lender's title insurance policy. This one is not optional. Your mortgage lender will require you to buy it for them. Let me repeat that. You pay for a policy that protects the bank. It makes sense from their perspective. They are giving you hundreds of thousands of dollars, secured by this house. They want to be absolutely certain that their investment is protected, and that no one else can come along and claim the property, making their collateral worthless. The lender's policy ensures that they have a valid, enforceable lien on your property. The coverage amount for this policy is equal to the loan amount, and it decreases over time as you pay down your mortgage. Once the loan is paid off, the policy evaporates. It never protected you, your down payment, or your equity. It only ever protected the bank. That's why the second policy is arguably the most important purchase you'll make at the closing table. The owner's title insurance policy. This is the one that protects you. It protects your down payment, protects your equity. It protects your legal right to the property for as long as you or your heirs own it. Unlike the lender's policy, this one is often technically optional. But buying a home without an owner's policy is like skydiving without a reserve parachute. It's an insane, unnecessary risk to your single largest financial asset. Let's go back to our horror story. The long-lost heir shows up and sues you, claiming they are the rightful owner. Without an owner's policy, you are on your own. You have to hire lawyers, go to court, and pay tens or even hundreds of thousands of dollars in legal fees to defend your title. And if you lose, you could lose the house and every penny you've put into it. Your down payment, your mortgage payments, your home improvements gone. But if you have an owner's title insurance policy, the situation is completely different. The moment that claim appears, you notify your title insurance company. They take over. They handle the legal battle. They pay for the lawyers. They pay the court costs. Their job is to defend your title. And if, in a worst-case scenario, the claim proves valid and you lose the house, the policy is designed to compensate you for your financial loss, up to the full purchase price of the home. The best part? It's a one-time fee. You pay it once at closing and that protection lasts forever. There are no monthly premiums, no annual renewals. One payment, permanent peace of mind. The cost varies depending on your state and the price of the home, but it's typically a few $1,000s on an average-priced home. And here's a pro tip. Who pays for it is often negotiable. In some parts of the country, it's customary for the seller to pay for the owner's policy as a way of guaranteeing to the buyer that they are delivering a clear title. In other areas, the buyer pays. It's always worth asking for the seller to cover it during your negotiations. Now, some people will tell you it's a scam, a junk fee. They'll say title companies rarely pay out claims. But that's a fundamental misunderstanding of its purpose. The primary goal of a title company isn't to pay claims. It's to prevent them. The vast majority of the premium you pay goes towards that exhaustive, upfront detective work, the title search, to ensure problems are found and fixed before you ever get the keys. The insurance portion is the safety net for the undetectable human errors, forgeries, and hidden risks that no amount of research could ever uncover. It's the final shield that ensures a problem from 1973 doesn't bankrupt you in 2023. So when you see this line item on your closing statement, don't view it as just another fee. See it as the purchase of certainty. You are buying a legally sound, professionally vetted, and financially backed guarantee that the home you are buying is truly yours. This concept of setting money aside for protection is a theme you'll see again. Because title insurance isn't the only major financial safety net you'll be funding at the closing table. You'll also be prepaying for future expenses. The bank isn't just going to trust that you'll save up for your property taxes and homeowner's insurance on your own. Oh no, they have a special mandatory savings account for that. It's called an escrow account, and it's one of the biggest reasons your closing costs can feel so surprisingly high. And that is exactly what we need to break down next. Think of an escrow account as a separate savings account that your lender manages for you. You deposit money into it every month as part of your total mortgage payment, and the lender uses that money to pay for two critically important and very large expenses on your behalf: your property taxes and your homeowner's insurance. Why can't you just handle this yourself? The simple, blunt answer is, the lender doesn't trust you. And honestly, it's not personal. They don't trust anyone. Remember, the bank just loaned you hundreds of thousands of dollars. The house is their collateral. It's the only thing of value securing that massive loan. So they have two huge fears. Fear number one is the government. Local governments, your city, your county, your school district, charge property taxes to pay for things like roads, schools, and fire departments. If you fail to pay those taxes, the government can put what's called a tax lien on your property. A tax lien is a legal claim against your house, and here's the terrifying part for the bank. A tax lien takes priority over the mortgage. This means if you stop paying your taxes, the government can eventually foreclose and sell your house to get their money back, and they get paid before the bank does. The lender could be left with nothing. They absolutely cannot let that happen. Fear number two is disaster. A fire, a tornado, a hurricane. If your house burns to the ground and you don't have homeowner's insurance, the lender's collateral, that beautiful house they just financed, is now a pile of ash. You might walk away from the loan, and they're left with a worthless piece of land and a massive financial loss. So they require you to have homeowner's insurance at all times. The escrow account is the lender's solution to both of these fears. It's their ironclad guarantee that these two critical bills will always be paid on time. They take on the responsibility. They collect the money from you in small monthly increments, hold it in that special account, and then pay the big scary bills when they come due. It's like having a very strict, mandatory bill-paying butler for your house. So your total monthly housing payment, often called PITI, stands for principal, interest, taxes, and insurance. The principal and interest go to the bank to pay down your loan. The taxes and insurance go into your escrow account. Now here is the multi-thousand-dollar question. If this is just a monthly payment, why does it make my closing costs so high? Because you can't start a savings account with a zero balance and expect to pay a huge bill next month. You have to fund it up front. At closing, the lender needs to collect enough money to make sure that escrow account is healthy and will never have a negative balance. This initial funding is what shocks people, and it's made up of two parts: prepaids and initial escrow deposits. Let's start with the easiest one, prepaids. For homeowners insurance, the lender wants proof that you are insured from the very first second you own the home. The way they do that is by making you pay for the entire first year of your homeowner's insurance premium, all at once at the closing table. If your policy is, say, $1,800 a year, you need to bring a check for $1,800 to closing. That's a huge chunk right there. It's a prepaid item. You're paying it in advance. Now for the tricky part, the initial escrow deposit. On top of prepaying for that first year of insurance, you also have to start funding the escrow account so it has enough money to pay the second year's insurance premium when it comes due 12 months from now. And you have to do the same for your property taxes. This is where the math gets a little fuzzy for most people, so let's walk through a clear example. Imagine your annual property taxes are $6,000, and your annual homeowner's insurance is $1,800. That means every month you need to save $500 for taxes, $6,000/12, and $150 for insurance, $1,800/12. Your total monthly escrow payment will be $650. That amount will be added to your principal and interest payment every single month. Now let's say you close on your house on June 15th. Your first mortgage payment isn't due until August 1st. Your county property taxes are due twice a year. A big payment on September 30th and another on March 30th. Let's look at that first tax bill. A massive $3,000 payment is due on September 30th. By the time that bill is due, you will have only made two mortgage payments. One on August 1st and one on September 1st. That means you will have only put 2 months' worth of tax money into your escrow account. 2 months at $500 each is only $1,000. But the bill is $3,000. You're $2,000 short. The lender sees this coming from a mile away. They are not going to be short. So what do? They collect that $2,000 shortfall from you at closing. They make you deposit it into the escrow account right from the start. But wait, it gets better. They don't just want to avoid a negative balance. Federal law, specifically the Real Estate Settlement Procedures Act or RESPA, allows the lender to keep a cushion in your account, a buffer, just in case property taxes or insurance premiums go up unexpectedly. This cushion is legally capped at 2 months' worth of your total escrow payments. In our example, your monthly escrow payment is $650. So the lender can legally hold an extra 2 months' worth of payments as a safety cushion. That's an additional $1,300, $650 x 2. So let's add this all up for closing day. First, you have your prepaids. You have to pay the entire first year of homeowner's insurance up front. That's $1,800. Second, you have your initial escrow deposit. We calculated the lender needed to collect a $2,000 shortfall for the upcoming tax bill. Third, the lender is adding their legal 2-month cushion, which was $1,300. So, the total amount you need to bring to closing just for your escrow account is $1,800 for prepaid insurance, plus $2,000 to cover the tax shortfall, plus $1,300 for the cushion. That is a staggering $5,100. This is not a fee. It's not money the lender is keeping. It is your money going into your savings account to pay your future bills. But it is due in cash on closing day. And that is why closing costs are so much higher than people expect. They see this massive escrow funding line item on their settlement statement and think it's a junk fee. It's not. It's your own money being put away for your own good, whether you like it or not. The exact amount you'll have to deposit depends entirely on the timing. It depends on your closing date and when your specific property tax and insurance bills are due. The lender does a complex escrow analysis to figure out the lowest point the account will hit in the next 12 months, and then works backwards to make sure that lowest point is never less than the 2-month cushion. The good news in all of this? Once a year, your lender is required to do an escrow analysis. They'll look at what they collected from you versus what they actually paid out. If your taxes or insurance went down, or if they overestimated and have more than the 2-month cushion in your account, they have to send you a refund check. It's a nice little surprise to get a check for a few $100 from your mortgage company. Conversely, if your taxes or insurance went up, they'll give you the bad news. Your monthly mortgage payment is about to increase to cover the new, higher costs. So escrow is a double-edged sword. It creates a massive upfront cost at closing, but it also provides peace of mind and budget stability by breaking down your largest annual bills into manageable monthly chunks. It's the lender's way of protecting their investment, which forces you into a disciplined savings plan. Understanding this single concept, that you are pre-funding a mandatory savings account, is the key to understanding why your cash to close is so much more than just your down payment. But these lender-related costs are just one side of the coin. There's a whole other category of fees you'll face, charged by people who have nothing to do with your bank. These are the third-party fees, and they cover the crucial work of making sure the house you're buying is legally yours and in good standing. And the most important of these is title insurance, charged by people who have nothing to do with your bank. These are the third-party fees, and they cover the crucial work of making sure the house you're buying is legally yours and in good standing. And the most important of these is title insurance. Now, title insurance sounds about as exciting as watching paint dry. But let me tell you, it is the silent superhero of your home purchase. It's the one thing that stands between you and a financial nightmare you never saw coming. Imagine this. You've closed on your beautiful new home. You've unpacked the boxes, painted the living room your favorite color, and you're finally starting to feel settled. Then one afternoon there's a knock on the door. It's a stranger, and they're holding a dusty old document. They claim that their great-uncle, the previous owner's long-lost brother, never signed off on the sale of the property decades ago, and that legally they still own a piece of your house. Or what if the previous owner had a major renovation done and never paid the contractor? That contractor could have placed a lien, a legal claim, on the property for the unpaid debt. And guess what? That lien sticks to the property, not the person. So now that contractor is coming to you for the $20,000 the last guy owed them. This is not a scare tactic, this stuff actually happens. And this is precisely what title insurance protects you from. Unlike homeowners insurance, which protects you from future events like fires or floods, title insurance protects you from the past. It protects you from hidden claims, errors in public records, forgeries, and undisclosed errors that could threaten your ownership of the property. Before you can get the insurance, a title company performs a deep, thorough investigation called a title search. They become property detectives. They dive into decades of public records, deeds, mortgages, wills, divorce decrees, court judgments, tax records, everything they can find related to your property. They're building a chain of title, a history of ownership, to make sure the person selling you the house actually has the legal right to sell it, free and clear of any other claims. They're looking for those hidden bombs, liens from unpaid contractors or unpaid taxes, easements, which are rights given to others to use your property, like a utility company needing access to a power line in your backyard. They're looking for boundary disputes, fraudulent documents, and anything else that could cloud the title. Once they've completed this search and cleared up any minor issues they find, they issue the title insurance policy. Now, here's a critical detail you need to know. There are actually two different title insurance policies. First, there's the lender's policy. Your bank will absolutely require this. It's not optional. This policy protects the lender's investment, their loan to you. If some title issue pops up later, and it turns out you don't legally own the home, the lender's policy ensures the bank gets its money back. This policy only protects the bank, not you. Its coverage amount decreases over time as you pay down your loan. Second, there's the owner's policy. This one is for you. It protects your investment, your down payment, and your home equity, for as long as you or your heirs own the property. If that long-lost relative shows up at your door, you don't have to panic. You call your title insurance company, and they will handle the legal battle. They will pay for the attorneys and court costs to defend your title. And if, in the worst-case scenario, they lose, the policy will compensate you for your financial loss, up to the full purchase price of the home. Now, an owner's policy is technically optional in some places, but I'm telling you, it is one of the smartest, most essential purchases you will ever make. It's a one-time fee paid at closing that gives you a lifetime of protection. Skipping it to save $1,000 or $2,000 is like playing Russian roulette with the biggest asset you own. Don't do it. The costs for the title search and both insurance policies will be clearly listed on your closing disclosure under title charges. Okay, so that's the big one. But there are other third-party experts whose work is vital. Next up is the appraiser. The appraisal is basically a professional opinion of your home's value. And it's another fee that your lender requires. Why? Because the house isn't just your home. It's the bank's collateral. If you stop making payments, the bank needs to know that they can sell the house and get their loan money back. They will not lend you $300,000 for a house that's only worth $250,000. So the lender hires an independent, licensed appraiser. This person is a neutral third party who has no stake in the deal. They'll visit the property, measure it, take photos, and assess its condition, its features, and its quality of construction. Then they'll do the most important part of their job. They'll find comps, which is short for comparable sales. They'll look for at least 3 similar homes in the immediate area that have sold recently. They'll compare your potential house to these comps, making adjustments for differences. Maybe your house has a finished basement, but the comp has a newer kitchen. Based on all this analysis, they'll produce a detailed appraisal report with the final estimate of the property's market value. Now, in a perfect world, the appraisal comes in at or above your purchase price. Everyone breathes a sigh of relief, and the loan process moves forward. But what happens if the appraisal comes in low? Let's say you agreed to pay $300,000, but the appraiser says it's only worth $280,000. This creates what's called an appraisal gap. The bank will only lend you money based on the appraised value, the lower number. So you have a $20,000 shortfall. At this point, you have a few options. You can try to renegotiate the price with the seller. You can try to dispute the appraisal if you think there were legitimate errors. You can come up with the extra $20,000 in cash yourself. Or, if your contract has an appraisal contingency, you can walk away from the deal and get your deposit back. The appraisal fee protects you from overpaying just as much as it protects the bank. Next on our list of third-party fees is the property survey. This isn't always required, but it can be incredibly valuable. A survey is a drawing, created by a licensed surveyor, that shows the exact legal boundaries of your property. It pinpoints the location of your home, your driveway, your fence, and any other structures in relation to those boundary lines. It also identifies any easements or encroachments. Why would you need this? Well, what if that beautiful 6-foot privacy fence you love so much is actually 2 feet onto your neighbor's property? That could lead to a legal dispute where you're forced to tear it down. What if the previous owner built a shed right on top of a utility easement, and now the city needs to dig it up to access a sewer line? A survey reveals these problems before you buy, not after. The cost is a few $100s, but it can save you thousands in legal headaches down the road. Finally, we have the fees that go straight to Uncle Sam and your local government. These are the government recording and transfer charges. When you buy a house, the change of ownership is a public event. The new deed, with your name on it, has to be officially recorded with the county government. This makes you the legal, public owner of the property. The county clerk's office charges a fee for this service. This is the recording fee. It's usually a pretty small amount, maybe a couple $100s. The potentially bigger cost is the transfer tax, also sometimes called a deed tax or stamp tax. This is essentially a sales tax on real estate. It's the tax the state, county, or even the city charges for the privilege of transferring the property from the seller to you. This cost varies wildly depending on where you live. In some states, there's no transfer tax at all. In others, it can be a significant percentage of the sale price, running into thousands or even tens of thousands of dollars on an expensive property. Who pays this tax, the buyer, the seller, or if it's split, is also determined by local custom and can be a point of negotiation in your contract. So to recap, these third-party fees cover the critical due diligence on your purchase. Title insurance protects your ownership from the past. The appraisal confirms the home's value for the present. The survey defines your physical boundaries. And government fees make your ownership official in the public record. These are the costs for services rendered by people outside your bank. But there's one more major category of closing costs we need to talk about. These aren't really fees for services at all. It's your own money that you have to pay up front to cover future expenses like your property taxes and homeowner's insurance. This is the world of prepaids and escrows. So let's break down this idea of prepaids and escrows, because it's one of the most confusing parts of closing costs for first-time homebuyers. The key thing to burn into your brain is this. This isn't a fee. You're not paying someone for a service. You are simply pre-funding your own expenses. Think of it like you're moving into a new apartment, and you have to pay the first month's rent and a security deposit. The first month's rent is a prepaid. You're paying for the month ahead. The security deposit is kind of like an escrow. It's your money being held by the landlord to cover future potential costs. It's the same concept here, just with a few more moving parts. Let's start with prepaids. The name says it all. You are paying for certain items in advance at the closing table. The two big ones are homeowners insurance and prepaid interest. First, homeowners insurance. Your lender is not going to give you hundreds of thousands of dollars for a house that isn't insured against burning down. It's the single biggest risk to their investment. So they have a non-negotiable rule. You must have a homeowner's insurance policy in place, and you must pay for the entire first year's premium upfront at closing. You can't pay it monthly, not for the first year. You shop for the policy, you choose the company, but the bill for that first full year comes due at closing. So if your annual premium is, say, $1,200, you need to bring that $1,200 to closing. It's a prepaid item. You are paying for the next 365 days of insurance coverage, starting from the day you close. Now for the tricky one, prepaid interest. This one trips everybody up, so let's walk through it slowly. When you make a mortgage payment, you are paying in arrears. That means you're paying for the interest that has already accrued from the month that just passed. For example, your mortgage payment on August 1st is actually paying for the interest that accumulated on your loan during the month of July. Your September 1st payment covers the interest from August. You get the idea. But what happens in the month you close? Let's say you close on your new home on June 20th. Your first official mortgage payment won't be due until August 1st. But wait, who pays the interest for the last 10 days of June? From June 20th to June 30th? You do. And you pay it at the closing table. This is prepaid interest. It's the per-day interest on your loan, multiplied by the number of days left in the month of closing. So your August 1st payment will cover all of July's interest, and that small chunk of June's interest gets paid upfront at closing. This is why many people try to close at the end of the month. If you close on June 29th, you only have to pay for 1 day of prepaid interest. If you close on June 2nd, you have to pay for 28 days of prepaid interest. It doesn't change the total amount you pay in the long run, but it does change how much cash you need to bring to the closing table, and that can be a big deal. So that's prepaids, homeowners insurance for the year ahead, and mortgage interest for the rest of the month. Now let's talk about the bigger bucket of money, your escrow account. If prepaids are about paying for things in advance, escrows are about saving for things in advance. Your lender is going to set up a special savings account for you called an escrow account, or sometimes an impound account. The sole purpose of this account is to save up for your property taxes and your homeowner's insurance renewal. Think about it. Your lender has a massive financial stake in your home. Two things could cause them to lose everything. If the house burns down and you don't have insurance, or if you don't pay your property taxes and the county seizes your home, they are not going to let you forget to pay these two giant bills. So they force you to save for them. Here's how it works. Each month, your total mortgage payment is made up of 4 parts: principal, interest, taxes, and insurance. We call it PITI. The principal and interest, the P and the I, go directly to the lender to pay down your loan. The other 2 parts, the T for taxes and the I for insurance, get deposited into your escrow account. Let's use an example. Suppose your annual property taxes are $4,800 a year, and your annual homeowner's insurance premium is $1,200 a year. The total is $6,000. The lender divides that by 12, which gives you $500 a month. So every single month, $500 of your mortgage payment is automatically swept into this escrow savings account. Then, when that big property tax bill comes due, you don't even see it. The lender just takes the money out of your escrow account and pays the county for you. When your homeowner's insurance is up for renewal a year later, same thing. The lender pays the insurance company directly from your escrow account. It's a brilliant system for people who aren't great at saving for massive, predictable bills. It's forced financial discipline. But here's the part that impacts your closing costs. The lender can't just start with a zero balance in that account. What if your first big tax bill is due only 3 months after you close? You would have only made 3 months of escrow payments, but the bill might be for 6 months of taxes. You'd be short. The lender can't have that. So at closing, they require you to pre-fund the escrow account with a cushion. Federal law allows them to collect enough to cover what will be due, plus a cushion of up to 2 months' worth of payments. So in our example, where taxes and insurance are $500 a month, the lender could require you to deposit a 2-month cushion, which is $1,000, into your escrow account at closing. They might also need to collect a few more months on top of that depending on when your taxes are due. If you close in January and the first big tax payment is in June, they'll need to collect about 4 or 5 months worth of tax payments at closing to make sure there's enough money in the account when that bill arrives. The math can get a little complicated, but your loan estimate will show it all in Section G. It'll list the homeowner's insurance premium, the mortgage insurance, and the property taxes, and how many months of each you're being charged for at closing to set up this account. This can be a huge number. For some people, the total of their prepaids and escrow funding can be thousands and thousands of dollars, sometimes as much as all the other closing costs combined. And it's a shock if you're not prepared for it. The most important thing to remember is that this is your money. If you sell the house in 5 years, whatever is left in that escrow account is refunded to you. It's not a fee. It's a savings account that you own, but that your lender controls to protect their investment. Now you might be asking, do I have to have an escrow account? The answer is maybe. For most loans, especially if you're putting down less than 20%, it's mandatory. Lenders see a smaller down payment as a higher risk, so they insist on managing your taxes and insurance to protect themselves. If you put down 20% or more, you often have the option to waive escrows. You could choose to pay your property taxes and homeowner's insurance on your own. But should you? For most people, the answer is no. It takes incredible financial discipline. It means getting a $10,000 property tax bill in the mail and having that money sitting ready in your bank account. For most of us, it's far easier and safer to have it automatically saved and paid through our mortgage. It smooths out a huge, lumpy expense into a predictable monthly amount. But if you are a super saver, a budget spreadsheet wizard, you might prefer to hold that money yourself and earn a little interest on it before the bills are due. Just know that if you choose this path and you miss a payment, the lender can and will force place an escrow account on your loan anyway. So, to recap this critical section, prepaids are you paying for things in advance like your first year of insurance and the interest for the current month. Escrows are you saving for things in advance, building a cushion in a special account so your lender can pay your future tax and insurance bills for you. Together, these items in sections F and G of your loan estimate represent the cash you need to bring to closing to cover your own obligations, separate from the fees you pay to the lender or third parties. Now, we've gone through all the major categories of costs. We've talked about what the lender charges, what the third parties charge, and the money you're paying to yourself. But there's a huge question looming over all of this. These numbers we've been discussing are all based on the loan estimate. What happens when it's time to actually close? How do you know the final numbers are right? What if the title fee suddenly jumps by $500? What can change, what can't, and how do you fight back if something is wrong? That all comes down to the single most important document you will get before closing day. It's called the closing disclosure, and it's your final report card on the deal. And understanding how to read it is the final skill you need to master. By law, your lender must send you the closing disclosure, or CD, at least 3 full business days before your scheduled closing date. This isn't a suggestion. It's a federal law enforced by the Consumer Financial Protection Bureau. It's called the 3-day rule, and it is your single greatest protection as a homebuyer. It's a mandatory cooling-off period designed to stop lenders from springing last-minute changes on you at the closing table when you're most vulnerable. This document is the culmination of everything. Every negotiation, every fee, every credit, every single dollar is laid bare right here. When that email lands in your inbox with the subject line, "Your closing disclosure is ready," your heart is going to beat a little faster. You'll open the PDF, and you'll be looking at 5 pages of dense, government-formatted text and numbers. It's intimidating. It looks final. But your job is not to just accept it. Your job is to become a forensic accountant for the next 30 minutes. Your one and only mission is this: to compare the closing disclosure, line by line, against the last loan estimate you received. That's it. That's the entire game. The loan estimate was the prediction. The closing disclosure is the reality. Do they match? Let's walk through it together page by page. Page 1 is your high-level summary. It's the mission briefing. At the very top, you'll see the closing date, property address, and your names. Make sure it's all spelled correctly. A simple typo here can cause massive headaches later. Then look at the loan terms box. Is that the interest rate you locked in? Is it fixed or adjustable? Is the loan amount exactly what you expected? If your rate was supposed to be 6.5% and this document says 6.75, you stop right there and you call your loan officer. This is a non-negotiable. Next, look at the projected payments section. This breaks down your estimated total monthly payment into principal and interest, mortgage insurance, and estimated escrow. Does this number look familiar? It should be very, very close to what was on your loan estimate. Finally, the most important number on this page is at the bottom right. Cash to close. This is the exact dollar amount you need to bring to closing. Not an estimate. This is the final certified number. This is the number you'll be wiring or bringing as a cashier's check. If this number is wildly different from your loan estimate, page 2 and 3 will tell you why. Now let's flip to page 2. This is the heart of the document. This is where the costs are itemized, and this is where you put on your detective hat. You'll see 2 columns. On the left are the loan costs, and on the right are the other costs. This page should look almost identical to page 2 of your loan estimate. Your job is to compare them. Let's focus on the loan costs on the left. Section A is origination charges. This includes points you pay to lower your rate, and the lender's flat fees, like an application or underwriting fee. These fees have what's called zero tolerance. That means they legally cannot increase from what was on your loan estimate. Not by $1. If they have, it's a red flag. Section B is services you did not shop for. These are third-party fees for services the lender requires and chooses for you, like the appraisal, the credit report, and the flood certification. These fees have a 10% tolerance. That means the total cost for everything in this section can't be more than 10% higher than the total for the same section on your loan estimate. Lenders are pretty good at estimating these, so a massive jump here is another red flag. Section C is services you did shop for. This is for things like your title insurance, your pest inspection, and your survey fee if you chose your own providers from a list the lender gave you. If you picked a provider from their list, these costs also fall into that 10% tolerance bucket. But if you went out and found your own title company, for example, then there's no limit to how much this could have changed because the lender had no way of knowing what they would charge. Now look to the right side of page 2, under other costs. This is where you'll find things like your property taxes, your homeowner's insurance premium, and any HOA fees. These are the prepaids. This is also where you'll find the big government fees in Section E, taxes and other government fees, like recording fees and transfer taxes. These should be extremely close to the estimate. They are set by the county and state, not the lender, so they shouldn't contain any surprises. This brings us to page 3. If page 2 was the itemized receipt, page 3 is the master bank ledger that shows how the final cash to close number was calculated. It can look confusing with its columns for borrower paid and seller paid, but the concept is simple. It starts with the sale price of the home and then shows a summary of all your debits, things that increase the amount you owe, and all your credits, things that decrease the amount you owe. Your biggest debit, of course, is the purchase price of the home. Your closing costs from page 2 are also added here as a debit. Your biggest credit will be your new loan amount. See how that works. The loan is money you're receiving, so it reduces the amount of cash you need to bring. Your earnest money deposit will also be listed here as a major credit. You already paid that, so it's deducted from your final bill. Did you negotiate for the seller to pay for a home warranty or give you a credit for repairs? That will show up here as a seller credit, directly reducing your cash to close. Go through this section carefully. Is your earnest money credit correct? Are all the seller credits you negotiated accounted for? A missing $5,000 seller credit is a $5,000 mistake that comes directly out of your pocket if you don't catch it. The final calculation at the bottom of this page should result in the exact same cash to close number from page 1. If it doesn't, there's a math error in the document, and you need to report it immediately. Pages 4 and 5 are mostly disclosures. Page 4 will confirm if you have an escrow account, explain what happens if you make a late payment, and detail the terms of your loan. You absolutely should read it, but it's unlikely to contain financial errors. Page 5 gives you the final loan calculations like your APR and the total interest percentage, and lists the contact information for everyone involved in the transaction, the real estate agents, the lender, and the closing agent. It's a good idea to double-check that all this information is correct. So what happens if you do this review and the numbers are off? First, don't panic. There are legitimate reasons for changes. Maybe you decided to switch from a conventional loan to an FHA loan halfway through. Maybe you decided to buy down your interest rate at the last minute. Maybe the appraisal came in low, changing your loan-to-value ratio. These are valid changed circumstances that would trigger a new loan estimate and explain the differences you see. But what if there are no valid reasons? What if the lender's underwriting fee in Section A suddenly doubled? What if a processing fee you never saw before just appeared out of thin air? That's when you pick up the phone. You call your loan officer immediately. You say, "I am comparing my closing disclosure to my last loan estimate, and I see a discrepancy on line B03. You are calm, you are respectful, but you are firm. It is your money, and you have a legal right to understand every single charge. Any reputable lender will be able to explain the change or, if it's an error, fix it immediately. This 3-day window is your time to resolve these issues, not at the closing table. Once you've done your due diligence, compared every line, and confirmed that the numbers are correct and the deal is the deal you agreed to, you are ready. You're ready to give the final green light. You've navigated the maze, you've checked the math, and you've advocated for yourself. The closing disclosure is accurate. You're clear to close. But the journey isn't over just yet. The final hours before you get your keys are often the most precarious. There are a handful of critical mistakes a buyer can make in the 24 to 48 hours before closing that can cause the entire loan to collapse at the finish line. And that final act of signing your name over and over on a mountain of documents, what are you really agreeing to? Let's talk about that moment. The final hurdle. You've navigated inspections, appraisals, and underwriting. You're exhausted but exhilarated. The finish line is in sight. And in these last crucial hours, a single misstep can send you tumbling back to the start. The lender isn't just taking your word for it. They perform a final verification right before funding. They will pull your credit one last time. They will call your employer one last time. They are confirming that the person they approved 2 weeks ago is the exact same person, in the exact same financial position today. So here is the list of absolute, unbreakable rules for the 48 hours before you close. First, and most obviously, do not make any large purchases. I know the temptation is screaming at you. You're mentally furnishing your new living room, picking out that perfect sectional, that 85-inch television. Resist. Financing a $5,000 sofa or a new car changes your debt-to-income ratio. The lender runs the numbers again and suddenly you don't qualify. Loan denied. It happens every single day. Your furniture can wait. Your new home can't. Second, do not open any new lines of credit. Don't apply for a new credit card to get that 15% discount at the home improvement store. Don't co-sign a loan for your cousin. Every time you apply for credit, it triggers a hard inquiry, which can temporarily dip your credit score. If your score was right on the edge of a qualification tier, that tiny dip could be enough to change your interest rate or even disqualify you entirely. The system is automated and unforgiving. Third, and this is a big one, do not quit your job or change your employment status. Your entire loan is predicated on your stable, verifiable income. If you decide to switch from a salaried W-2 position to a 1099 independent contractor role 2 days before closing, even if you're making more money, your loan is dead. Lenders need a 2-year history for self-employment income. Changing jobs, even for a better one in the same field, can raise a red flag that forces underwriting to start all over again. Wait until after the keys are in your hand. Fourth, do not make any large, undocumented cash deposits into your bank account. That $20,000 your uncle gave you as a gift? If you just deposit it as cash, the lender will see it and freak out. To them, it looks like you just took out an undisclosed loan, which again wrecks your debt-to-income ratio. All large deposits must be sourced and seasoned. That means you need a paper trail like a formal gift letter and proof of the funds coming from the giver's account, and it needs to have been done weeks in advance. A last-minute cash dump is the reddest of red flags. So you've navigated that final minefield. You arrive at the closing table. In front of you is a stack of paper that looks like a novel. Your hand is going to cramp. Your signature is going to devolve into an illegible scribble. But what are you actually signing? It all boils down to 3 monumental documents. The first is your final closing disclosure, the CD. We've talked about this. You should have received a preliminary version at least 3 business days prior. Your job at the closing table is to play a game of spot the difference. Compare the final CD in front of you with the one you already reviewed. Do the numbers match? Are the loan terms, the interest rate, the loan amount, the monthly payment exactly what you agreed to? Are the seller credits there? Are the fees from the lender and title company what you expected? This is your last chance to question anything. Once you sign, you are agreeing that these numbers are correct. This is the financial blueprint of your deal. The second, and arguably the most personal document, is the promissory note. This is the IOU. It's a surprisingly simple document, but it is pure financial power. It's your direct, legally binding promise to the lender. It says, I, your name, promise to pay the lender the sum of loan amount, with an interest rate of your rate, over the course of number of years. That's it. It's the core of the debt. It doesn't mention the house. It's just your word, your promise, your obligation. This is the document that makes you responsible for paying back hundreds of thousands of dollars. The third pillar is either the deed of trust or the mortgage, depending on your state. Think of it this way. If the promissory note is the deed of trust is the or else. This is the document that connects your promise to your property. It's the security instrument. It says, and if I fail to honor the promise I made in the promissory note, I give the lender the right to take this specific property, sell it, and use the money to pay off my debt. This is what makes your home the collateral for the loan. It's the document that gives the bank the power to foreclose if you default. These two documents work together. One is your promise to pay, the other secures that promise with your house. You'll sign many other things. Tax forms, compliance disclosures, title documents, but those three are the heart of the transaction. You are affirming the final numbers, promising to repay the debt, and pledging your home as security. And then it's over. The attorney or title agent gathers the papers. They might make a few phone calls to confirm the lender has funded the loan. And then, in a moment that feels both climactic and strangely ordinary, they slide a set of keys across the table. They're yours. The weight of them in your hand is real. The culmination of months of stress, saving, and searching. You did it. But the journey isn't quite finished. In the weeks after you close, a few more things will happen. First, don't be surprised if you get a letter saying your loan has been sold. This is completely normal. Lenders are in the business of originating loans, not necessarily servicing them for 30 years. They often package them up and sell them to a larger servicing company. Your loan terms, your interest rate, your payment, nothing changes. You'll just be sending your check to a different company. Second, you'll receive the original recorded deed in the mail from the county clerk's office. This can take a few weeks or even a couple of months. This is the official government-stamped proof that you are the legal owner of the property. Guard this document with your life. Store it in a fireproof safe or a safety deposit box. It is the ultimate proof of ownership. And here's one last pro tip, a piece of immense value many new homeowners miss. Look into filing for a homestead exemption. Most states offer this. It's a simple form you file with your local tax assessor that can significantly reduce your property tax bill. By exempting a portion of your home's value from taxation, it can save you hundreds, sometimes thousands of dollars every single year, but in most places you have to apply for it yourself. It isn't automatic. And that brings us to the end of this journey. We started with closing costs as this vague, terrifying number, a black box of mysterious fees designed to drain your bank account. Now you see it for what it is. It's not a mystery, it's a system of checks and balances. The cost of appraisal is the cost of confidence in your investment. The cost of title insurance is the price of peace of mind, protecting your ownership from the ghosts of the past. The cost of escrow is the price of stability, ensuring your taxes and insurance are paid on time every time. These costs are not arbitrary fees. They are the scaffolding that builds a secure, legal, and lasting transaction. You are not just buying a house. You are buying a clear title, a verified valuation, a legally recorded deed, and a stable financial structure for the life of your loan. You are paying for professionals, appraisers, inspectors, attorneys, underwriters, to protect you and your lender from catastrophic risk. You are now armed with knowledge that most homebuyers simply don't have. You can read a loan estimate and a closing disclosure with confidence. You can ask intelligent questions. You can spot red flags. You can walk into that closing, pick up that pen, and sign your name not with fear, but with the profound understanding of the incredible achievement you've just unlocked. You haven't just learned about closing costs. You've learned the language of homeownership. The keys are waiting. Go get them.